Welcome to the award-winning Moneymakers podcast. I'm Jonathan Davis, the founder and host. For more than 6 years now, we've been providing comment and discussion about all the latest developments in the world of investment trusts, the stock market listed funds often called the City of London's best-kept secret. I'm grateful to JP Morgan Asset Management for their continued no-strings support, which enables us to keep the podcast free while preserving our truly important independent editorial principles. Please note that while our comments are well-researched and our opinions honestly held, we do not offer individual stock recommendations. This week on the podcast, I am talking to Max King, the former fund manager at Investec and elsewhere, who now writes regularly for Money Week and other publications, and regularly about investment trusts. Max, it's good to have you on again. I think we should probably start with the big picture. Perhaps we could start with the mystery of the fact that despite the fact that all the punditry mafia have said that Trump's involvement in the Iran war has been a disaster, it hasn't actually quite worked out that way just yet, has it?
No, well, it's been a brilliant start to the year for investment trusts, especially April and May. All you had to do was ignore the doomsayers talking about how technology was a massive bubble and geopolitics was a disaster. Just had to ignore them, and you actually made really good returns. We saw in the first 5 months or so, discounts decline, buybacks reduce, issuance increase, and very good money was made. There was a mild setback in June, which I expect to continue into the third quarter, but all seems set pretty fair. And as you talk about the war in Iraq, well, the commentary has been very one-sided. The reality is that the Iranian attempt to close the Straits of Hormuz was really a failure. The oil price perked above $100 a barrel a couple of times, but it didn't stay there. And next time they try it, it'll be even less effective.
Is there a general lesson here about being wary of doom-mongering? I mean, looking back over my experience over many years, there have been disaster periods, obviously, with severe bear markets. But you could certainly say that in the run-up to all of those, for several years before they actually happened, there were lots of doomster voices. I remember William Rees-Mogg, the former editor of the Times, wrote this book called Picnicking on Vesuvius back in the 1980s, and there's been many in that particular theme as well, Robert Prechter and people like that. So would your advice be, as a general rule, be very sceptical about doomsters?
Yes, well, the doom-mongers are nearly always wrong. And the reason is that if it bleeds, it leads. So basically, bad news sells and good news doesn't. And the idea that the market is going to go on upwards is a boring article. So, well, the idea that the market's going to collapse and it's a disaster is big news. So there is an overwhelming vested interest in spreading bad news. And investors just have to ignore that. And the best thing to do this year has just been to go with the flow, to stay with it, and not to try and overthink the problems of the world, because what drives markets is earnings and long-term earnings growth. It's not geopolitical events, as Ed Yardeni regularly shows.
But we have seen one thing has happened this year, which again has perhaps confounded market followers, if I can put it that way, which is that interest rates haven't come down as many hoped, perhaps unwisely hoped. In fact, we've seen 10-year bond yields have edged up a little bit, and they're getting close to 5% now. So is that going to be a constraint on, it will have an impact on earnings in due course, but is that going to be a constraint on the markets, do you think?
Well, bond yields have been edging up, although every time they hit 5%, they edge back. I don't think it's because of fears of inflation, really. I think inflation pressures are rather muted, largely because monetary growth is under such good control. So I'm not really expecting higher interest rates. They may come down a bit, but it's real interest rates that have gone up. Real interest rates, which were negative for so many years, have turned very sharply positive. I expect them to stay there or maybe go even higher. So I don't think the bond markets are going to give us any help. And I think in the UK, people are hoping for the bond vigilantes to call the government to account in its wild extravagance and spending in its massive bond issues. But I tend to think that the bond vigilantes are rather a tame lot. They were busy leveraging up to buy more and more gilt right at the top of the bull market 4 years ago. So why would they call time now? As for the equities, I do have a very firm view as to when you can tell the top of the bull market, and that's when the UK investors start buying. When investment trust discounts disappear, there are new issues left, right and centre, and the UK investor is piling into the stock market and into investment trusts, that'll be the time to get cautious. And we're still some way away from that now, I think.
Indeed we are. Well, you say that we should ignore, by and large, politics and geopolitics, but you must have some concerns about the impending change of Prime Minister in this country. Or do you? Or do you think that Andy Burnham is going to make a difference or make no difference at all?
I think we'll know pretty quickly, because there are some easy wins he can take short term to instill confidence. And if he takes those, then he's got a chance. If he doesn't take those, he hasn't got a chance. The obvious easy win would be to allow drilling in the North Sea and to reduce the North Sea oil tax, which would actually raise considerable amount of revenue. If he does that, I think we can say that he starts off on the right foot. And maybe appoint a sensible Chancellor of Exchequer rather than Ed Miliband. That would be a positive sign. But otherwise, it's going to go on getting worse. But the point for investors is you don't have to worry about the UK too much because the UK is now barely 3% of the global market. Focus on where things are really happening, which is the US and emerging markets, and Japan looks rather good. Europe looks interesting, but not the UK. The UK is full, I think, of well-run companies with mediocre prospects. And that's not a very attractive opportunity at the moment, particularly since the market's done quite well over the last couple of years.
It has done quite well over the last couple of years. I mean, the bulls of the UK market say, well, look at all the takeovers that are happening, look at all the M&A. We've just seen EasyJet being bid for, though the days when airlines are a growth business will be interesting to see. Do you think we should read anything into that? Does that mean that there might still be at the margin some increase in demand for UK stocks at some point?
Oh, I think there will still be upside, but investing for takeovers has always been a very specialist thing to do. You make real money by buying good companies and just holding on to them, or good funds year after year and just multiplying your gains. And the short-term gain you get from a takeover of 30% or whatever is nice, but it can be quite a long wait to get there. And I think investors in Tate & Lyle, for example, have finally got out, but it took a long time of mediocre or zero returns to get there. So I think investing for takeovers takeovers in your portfolio are nice when they happen, but it can be a long wait to get there. And sometimes investors sell out of takeover prospects really rather too easily. And I quote in one article the example of Arm, which all the investors were delighted to sell 10 years ago for what seemed like a good valuation, and yet it turned out to be a derisory valuation. I don't know whether the share price or the valuation is multiplied, was it 7, 8, 10 or 20 times? But if it was still quoted, it would be the UK's largest company by far.
Well, that is another issue indeed. You talked about the investment trust sector it has revived. As you say, the discounts have come in and the need for buybacks has reduced somewhat at the margin. How much credit for that would you give to our friends at Saba Capital?
Very little indeed. I think that the reality is people have made money, and making money is always a great draw for the stock market. I think last year, what happened was that companies were withdrawing capital faster than investors were selling. And I think now investment trusts are still withdrawing capital, but investors aren't selling so much. In fact, in some cases, investors may well be buying at the moment. So I think it's buyers exceeding sellers which is driving the market up. It's not Saba Capital. Saba Capital is actually quite interesting. So as I pointed out in an article, at Edinburgh Worldwide, they appear to have taken control, but their appointees as directors have kept Baillie Gifford on, it seems. And the mooted strategy of turning it into a trust, investing in other investment trusts, is a really stupid idea. And keeping with Baillie Gifford as existing managers is a much better idea. Baillie Gifford did an extraordinarily good job with SpaceX. And it was only the non-executive director's decision to sell 40% of the holding at exactly the wrong time that doomed them to departure.
Right. So do you think that the fact that the FCA has now come up with all these proposals to try and stop Saba or others doing what Saba has been trying to do, which is to appoint themselves as managers, do you think that's too little too late, or is it irrelevant, or is it praiseworthy?
Well, I think it's praiseworthy. The FCA has been showing really good signs in recent months, well, this year, doing a bit of a U-turn. They're now trying to encourage people to invest in stocks and shares rather than discourage them. It's now all about the opportunity rather than about the risk warnings. I'm impressed by the way they're behaving now and what they've done in the Saba case. In the Saba case, I actually thought that the mechanism for making life difficult for them was always there. That when a large shareholder tries to oust a board of directors, that is effectively a takeover. And I think all these transactions should have fallen under the auspices of the takeover panel. The takeover panel says that when a bid fails, you cannot bid again for 1 year. And I thought that would have been a very good rule for investment trusts under Saba attack. But what in fact happened is Saba failed, and then they came back again and again a couple of months later. And I don't think that that's reasonable. The takeover panel rule is a very good one and should have been applied in this case. I'll be interested to see what happens now at Edinburgh Worldwide. I actually sold out and switched into Pacific Horizon, my personal holdings, but I'm not sure whether I'm rather regretting it, because I think that actually if the independent directors keep Baillie Gifford on and things continue, then actually it might continue to be a good investment. In fact, it's done rather well since Saba appointed directors took the reins.
Yes, well, there's obviously at least a couple of examples now of where they are in that position. I happened to talk to one of the new directors of another trust nominated by Saba, and it's interesting. I think we may yet be surprised how they perform.
I think Impact's environmental, those directors panicked, and I think they rushed to exit, left a very small investment trust, and I don't think they needed to. So I think it's a great pity that investment trust is sort of largely disappeared, and I don't think in that case the directors did a great job. I think Impact's environmental was a very interesting trust. It wasn't going to go with the market. There would be phases of good performances and phases of bad performance. And I think that that was closed down at exactly the wrong time.
And what do you think about the future for Herald? It's much reduced in size as well, and it's moved to Aberdeen now with the same team, at least for the moment. Can they rebuild themselves if the record was so good and so on? Can they rebuild back to the kind of size they were, or is it just a question of a leaner future?
Well, I think they've still got over 500 million of assets. And when Katie Potts started up, I think it was about 50. So I think that they can certainly continue. And so long as Katie Potts is around and her team is around, I will continue to be an investor. It has shrunk drastically. I think they were perhaps a bit generous on the buyback. But if 40% of the trust remains and continues to do what it's done in the past, I think it might continue to be a good investment. So that was a very good example of how you should behave rather than panic like EWI and Impact did.
And looking at the kind of performance of the investment trust so far this year has been, as you said, pretty good. It's been up around 10%, I think, something like that. The index is up around 10%. But there have been obviously a lot of swings and roundabouts, ups and downs, if you like. And there have been some sort of notable poor performers. I just pick out three, perhaps. We've got Pershing Square Holdings, 3i, and HG Capital. Do you have any thoughts on any of those in particular?
Well, 3i got overhyped, I think, on the back of Action. And these retailing rollouts are a huge, great way to make money. But there comes a time when they get overcooked. And I think that 3i on the back of Action got overcooked. And now I suspect it's got rather undercooked. So I suspect that now that the 3i is looking rather attractive. And I thought that 3i X Action was really interesting, but I thought that the Action story was largely over and is rather a mature company. And if 3i are able to spin out Action into a separate company, I think the Rumble 3i will be well worth backing. As for Pershing Square, well, I'm rather disappointed that they gave up on Universal Music. I think that's a great pity. And I'm also sort of disappointed that they haven't made more of their stakes in Fannie Mae and Freddie Mac. But I think the thesis was brilliant on that and has great potential. But the US government doesn't appear to be moving in terms of doing very much about it, which would monetize the huge stake the government's got in it. So that's been disappointing too. And their new investments haven't really been particularly jaw-dropping in terms of interesting, unusual ideas. So I think Pershing Square has got a bit dull rather than I'd like to see them doing something really interesting. As for HG Capital, well, there is a worry about the software sector. I think the worries are valid. The prospects for these companies in the short term is pretty good, but people are right to worry that the long-term prospects may not be quite so good. So HG Capital is derated, but I'd have thought from here it looks quite an interesting vehicle.
I think one of the factors in terms of Pershing Square Holdings was this idea that when Bill Ackman started a new US vehicle equivalent, that was going to be beneficial for Pershing Square Holdings over here. But that doesn't seem to have happened, actually. Do you think that's a faulty logic? The idea that it's more attractive, you get a better deal investing in Pershing Square Holdings in London than you would do in this new vehicle that he has over in the States, which is much bigger.
I don't think it was ever going to be material, but I'm more concerned that he's bailed out of Universal Music, which actually I thought his thesis was very good. He couldn't get control, so he bailed out. Why? If it's still a good investment, why not stick with it? Just like a few years ago, he bailed out of Netflix, which turned out to be a terrible mistake. So I think he's far too impetuous on the sell side. And I think perhaps he assumes that there's a better investment over the horizon he can jump into, and maybe there isn't. In the tech sector generally, the one thing I think is quite interesting is that Allianz Technology Trust and Polar Capital Technology Trust, so they both moved to 10% discounts because investors are assuming that it's all over for the tech sector. And I don't know. I mean, you could have assumed that many times in the last 30 years and be wrong. It may still be wrong.
You are listening to the Moneymakers podcast. To keep up with every single item of news from the investment trust sector and all the latest share price, NAV and discount movements, why not try a subscription to the Moneymakers Circle, our premium content newsletter? You'll find there our in-depth, independent profiles of more than 200 investment trusts and more commentary. Go to money-makers.co for more details. Do please like, subscribe and share through whatever platform you're using. As well as the usual podcast channels, we can also be found on YouTube, TikTok, X, Blue Sky, and most recently on Substack. Visit the website for more details. Let's just quickly move through some of the areas that you've mentioned. We'll start with the UK because it is the smallest part of many people's portfolios these days, as you've correctly pointed out. But looking across the sector, you've still got some favourites there?
Well, in the UK, I still think the mid and small cap area is quite interesting. It seems to be Nick Train's Finsbury Growth Trust continues to have the potential to turn around. Some of his companies have been hit hard by fears of AI, others by what seem to be market trends. And I think that people forget that London Stock Exchange derives 97% of its business away from the London Stock Exchange. Diageo seems to be benefiting from an upturn in drinking in the US. And I think that's a good trust, a UK-based trust of UK companies investing globally. So I think there is good value in the UK market. And the big point about the UK is that with these trusts and long-standing favourites like Temple Bar, they have shown a persistent ability to beat the market. But I think it should only be a small part of any investment trust investor's portfolio. And actually, the more interesting things are elsewhere. The healthcare is certainly picking up quite strongly now, and I think that that's an area to be invested in. Property has been absolutely clobbered in the last few years, and I think that has the potential to get much more interesting. But generally speaking, I'd say on most investment trust areas is we've had a good run. We need the earnings of the underlying companies to catch up with the market ratings. And that way we can perhaps have a reasonable end to the year and a good year next year. Otherwise, we'll get into overvalued territory and market volatility.
You've mentioned Pacific Horizon. Have you been doing the same as many professional investors have been doing, which is perhaps they may be regretting it now, but they didn't initially, sort of moving away from exposure to the US, or at least reducing it at the margin, and in particular moving into Asian and emerging markets, which is partly an AI story, of course. What have you been doing in that area?
Well, you have to remember that in the Far East, the market is dominated by their sort of magnificent three, which is SK Hynix, Samsung, and TSMC. Also, people seem to think that the US market is being driven totally by AI and technology. And then you have to look and see companies like Costco and Walmart trading on 40 times respective earnings. There are a lot of very high valuations in the US market outside the technology sector. And that's what makes me think that actually that if the US market doesn't do anything for the rest of the year, I'd be pretty happy. Then you'll end the year on a prospective multiple of 20 or perhaps a little below, and that's reasonable value, particularly with a 10-year yield of around 5%. But if the market goes on shooting upwards, then I'll get nervous. Japan still looks attractive, but it looks attractive mainly because the yen is so cheap. But the problem with Japan is that if the yen goes up, the stock market is going to be fighting the current. So that market's done very well, as have Asian markets. So I think they're due a pause. I rather like Charles Gabb's idea of buying Japanese bonds, actually. I think that's a really good idea. He says that 10-year bonds yield 2.8% and 30-year bonds yield 4%, and yet the yen is very cheap. And the Japanese economy and government finances haven't looked this good for decades.
Indeed. So buying Japanese bonds, that would certainly be something that you wouldn't have done a little while ago, for sure. I have to ask you this, Max, as a seasoned campaigner. How are you using AI at the moment, if at all?
Well, I like writing articles. If I use AI to write articles, then, what's the point? It's all about sort of innovation. And I was very struck by a comment which I heard Chris Whitty say on Monday about AI. And he says the AI is very good. It's continuing to plow a well-plowed furrow. What it's not good at doing is lateral thinking, cognitive jumps, being a contrarian. And that's the way the great innovation has happened in the past. And that's the way to make money. And that's the way to think when you're coming up with ideas. AI is quite useful if you're an index hugger and if you just want to write in the conventional stream. But if you want to do something a bit different and come up with unusual ideas, then it's not going to be of much help to you yet.
And in terms of actually kind of analysing stocks and so on, you don't use it for that?
Well, I don't really look at stocks too deeply. Now, I've always thought that actually, when I was a professional investor, that analysing stocks was a question of inspiration rather than perspiration. Sometimes you had to have one good insight or two, or perhaps three good insights about a company. And the more you analysed it, the weaker those insights became. So have a great insight, then buy, and don't be put off by doing too much detailed analysis. And I think that's often the case. So AI will cause you to be cautious, more cautious than you want to be. I think people have forgotten that investment is not about due diligence. massive due diligence won't result in better answers or better decisions. It will result in greater confidence in poor decisions.
I guess you could say it might produce more accurate pricing overall in the market, but doesn't mean that it will give you the advantage of actually outperforming the market.
I don't think so. But, many people will use it. Many poor fund managers will find it's a good way to keep their jobs.
Indeed. There will be some jobs lost, I think. I mean, I always thought as soon as AI came out and they started talking about hallucination and the ability to fantasize, it would make them very good fund managers. They'd be able to present very well.
Well, I don't think AI does that. Hallucination and fantasizing, which actually may be a problem.
What else can I ask you about? What about, tell me what you think about these mooted attempts to make pension funds invest more in the UK stock market. Do you think that's a good idea?
Well, they all crashed out at low points of the market years ago to pile into government bonds. All those pension funds which sold ARM at a silly price 10 years ago were desperate to invest in government bonds yielding 2.5%, which in the short term appears to be quite a good idea, but turned out to be a terrible idea in the longer term. So I'm not sure pension funds have the capacity to invest wisely. Some, like University Superannuation Scheme, have continued to invest in equities throughout and have done very well. But for a pension fund to rebuild its expertise in equities, I just think it goes against the grain. I think that people should invest because they want to and not because they're compelled to by government diktat. So I'm not particularly hopeful about the institutional investor returning. I think markets will continue to be driven by the retail investor. That's the important area of the market. It's never been easier for investors to invest directly in stocks and shares, to get the information they need off the internet, to use platforms. On a platform, you can buy and sell shares in about 30 seconds. Try doing that for an open-ended fund. I came across this about a month or so ago when I wanted to buy into an open-ended fund. So I asked the broker to buy some, and he says, well, what class of shares do you want to buy? And I thought, I don't know what's available. And there was about 12 different classes of shares. And, which is the best? It's just a huge amount of diligence if you want to buy an open-ended fund, whereas investment trusts are really rather easy. So I expect in the investment trust area, the investment trusts will continue to come back into favour, but it's rather difficult for the open-ended funds, particularly since the well-publicised ones like Woodford have crashed and Fundsmith is struggling.
So if we look at the kind of future investment trusts, which is obviously the vehicles that we spend a lot of time looking at, there's a threat not so much from open-ended anymore, but from ETFs and passive vehicles, or now active ETFs. Is that a long-term threat to the survival of the investment trust sector?
I don't think so, because investment trusts have the record of being pretty low cost, being able to use the gearing, being able to use the advantage of a fixed portfolio, and having supervision by the independent board of directors. And active ETFs are only piggybacking off closed-end funds. And we've seen persistently over time the investment trusts outperform open-ended funds year in, year out in nearly every sector. And I think that will continue and benefits them greatly. The real pity with investment trusts is that in some sectors, there isn't a good choice. I mean, if you want to invest in Latin America or EMEA, East Europe, Middle East, Africa, you're down to one trust. In the energy sector, there's, I think, only one. And there isn't an awful lot of choice. And all these mergers and takeovers, is maybe they're getting rid of some underperforming trusts and they're strengthening the good ones, but it is reducing investor choice, and that bothers me. Actually, I think energy is a good place to invest at the moment. Fossil fuels and non-fossil fuels. I think that sensible governments, which does not include the UK, are going to want to encourage domestic energy production, drilling for oil and gas and such like. And I think that means that a relatively benign environment for fossil fuel companies. Whereas for renewable energy companies, the imperative to increase usage of renewable energy at the expense of fossil fuels continues to be very strong.
Finally, then, I have to ask you about gold, Bitcoin, those sort of things, and the defensive trust you can buy, which protects you against market falls, or at least promise to do so. What are your thoughts about that category of investment? Do you still have a lot of those or not?
Defensive trusts, I think they'll continue to lag the markets, and their time will come, but not yet. I think that their time will probably come when it becomes the sort of people say, oh my God, these people are absolutely awful. They've underperformed year after year for the last 5, 10 years or whatever. Their time always comes when people give up on them. I think the gold price came a long way, and people think that because the gold prices are treated down to $4,000 an ounce, therefore it's right to buy. But it's $4,000 an ounce is still a very high price. I think that over $5,000 an ounce will not be seen for many years to come. So I would hold back from gold. And as for Bitcoin, I've never really been a fan of Bitcoin. And I think that some of the drivers of Bitcoin are diminishing. I think if you're a law-abiding person living in a law-abiding country without exchange controls, you're never going to understand Bitcoin. But if you're a Russian soldier or a Mexican drug smuggler, then Bitcoin is your currency of choice. That's not a company I want to keep.
Okay, so that's been a very entertaining and insightful gallop around the world markets. Thank you very much, Max, for sharing your thoughts with us, and look forward to the next one, whenever that may be.
Thank you for listening to the Moneymakers Investment Trust podcast, sponsored by JP Morgan Asset Management and independently produced and edited by Moneymakers. If you like what you have heard, do tell your friends and colleagues, and remember to subscribe through your favourite podcast app or at the website so you never miss an episode. And follow us on our social media channels. For more news, commentary and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription. All details are at the website money-makers.co. Podcasts are provided for educational purposes only, and nothing you have heard from any speaker should be regarded as constituting investment advice.